Hello and welcome to the Airlie Australian Share Fund's quarterly video. I am the portfolio manager, Emma Fisher. You can probably tell that I've lost my voice, so I've roped in some friends today to join me and do the talking for me. I am joined by our senior investment analyst, Joe Wright, as well as our investment analyst, Jack McNally. Thanks so much, guys.
No problem to be here.
So you guys have been crisscrossing North America for 2 weeks in September and meeting companies. I'm interested to hear your insights for portfolio holdings, for interesting meetings that you had, as well as obviously the big questions like what did you pay for a cup of coffee? So Joe, we might start with you. And before we get into the meetings, the general vibe of the place in the economy.
Yeah, no problem, Emma. Look, I'd say in one word, expensive. I was fortunate enough to head to the US only 12 months ago, and prices, food, transport, things like that, still really high. I think I'd paid US $7 for a cup of coffee in New York, which is probably the most I've ever paid for one. Overall, it still felt very busy. It still felt very active. Flights were packed, bars were full. And so overall, it didn't really feel like there was much of a slowdown taking place yet.
Interesting. And Jack, what were your insights?
Yeah, look, I think the coffees were expensive for me as well. I think, look, the economy felt robust despite all the rising interest rates, the high inflation and reportedly dwindling savings. Everything seemed strong. The airports were full, accommodation was busy, bars were busy and restaurants were busy. And so, yeah, I think there's a continuation of what we've seen in that post-COVID strength. And I think another interesting thing to talk about is just because it came up quite a bit, is just the impact the effect of the low mortgage rates in the US that were entered into during COVID. So by contrast, in the US, when you enter into a mortgage, it's a fixed rate mortgage and you're locked in at fixed rate for about 10, 15, 20, or even 30 years. And so what that means is that if you're locked in at a low rate, like some of the people during the pandemic were, it's very unlikely that you would move house to borrow at a higher rate. And we think the implication that this is having is one, and I think we're going to talk to that, the impact on portfolio companies. Housing activity is really subdued. But then in addition to that, the impact on consumer spending for those people who have taken out those rates, they're essentially in a position now where they're more or less, apart from their principal repayments, paying very little for housing. And the impact that I think that will have on the spending for a long period of time to come is quite interesting to think about.
Yeah, and I mean, most people have probably just got the biggest pay rise that they've had in, decades as well. So it's definitely playing into that consumer strength. It's interesting that you mentioned the 30-year mortgage rate, because obviously one of the impacts of that is that few people are moving houses. And we know that when you move house, that's typically when you do a repair or remodel, a renovation. So that market has actually softened. Now, what's been really interesting is one of the biggest beneficiaries in the portfolio of the last 12 months has been James Hardie, which does skew towards that repair and remodel market. So we've been, happily surprised, I guess, by the resilience of their earnings. Joe, could you maybe tell us a little bit about any insights you had into James Hardie and how the cycle's faring over there?
I went all around the US and met with some of James Hardie's competitors as well as some of their customers, just to get a feel for the impact the housing activity slowdown has had on their business. Look, I think first of all, there was a narrative that, as interest rates rose and people stayed in their houses or chose not to move because they would have to take on a higher mortgage rate, they would be more inclined to undertake a repair or renovation project. The reality is actually the point at which you're most likely to do an R&R project is when you move house, because you get into a house, there's something about it you don't like, and so you start a project. And so, the reality is, as rates have come up, that R&R market has softened considerably. Now, from Hardie's perspective, they've done a great job of pivoting their business more towards the new home market, because as less people have moved houses, the only other way to buy a house, if you're still looking to purchase, is to buy a new home. And the new home builders we spoke with have talked about the competition they usually have from existing home inventory being very low at the moment. The US is still structurally short houses, and so new home building businesses have actually held up really well to the benefit of a business like James Hardie's, whose earnings have also proved incredibly resilient. And the work we did on the ground over there and the meetings we had suggested that's still going to play out. And you're seeing that to date in Hardy's earnings.
Thanks. Over to you, Jack. So you mentioned that you visited Vegas. Obviously, Aristocrat, which is a key portfolio holding, they generate a lot of their earnings from the land-based casinos over there, primarily in Vegas. What did you learn from meeting companies on the ground there?
Yeah, we had some great meetings. We met with over 15 companies in Vegas that span all of Aristocrat's operations. I think at a high level, it's that continuation on that destination revenge travel theme. The operating environment remains incredibly robust, and for the foreseeable future, they see ongoing strength. I think from the Aristocrat point of view, it was extremely reaffirming for us. We see a lot of industry survey data come through here in Australia, which shows things like Aristocrat having 17 of the top 25 leased games currently, as well as having over 30% ship share in the more competitive outright sales market. And then being on the ground, that it did reaffirm it for us. So the high-level feedback is that Aristocrat is heads and shoulders above their competition in terms of management quality, in terms of operational excellence, and in terms of content quality as well. And I think the other interesting thing when I was on the ground there, just related to they're on the cusp of launching their new NFL product. And NFL is a massive sport in the US. I think it's 150 million people view it in North America alone. And then of that, 50 million people visit a casino each year of that cohort. And Aristocrat sees this as an incredibly exciting opportunity to pursue 20 million unique customers who visit those casinos, but they're not currently a customer. So we're really looking forward to seeing how that takes off, and we'll be monitoring that closely.
Thanks, Jack. So, Joe, one of the cracking calls in the fund over the last 12 months has been QBE. Probably fair to say, though, that the one part of the business that isn't really firing has been the North American business, which remains in turnaround mode. What are the insights that you got from meeting with competitors and brokers on the ground?
Yeah, so went over to New York and met with 4 of QBE's largest competitors in the US. That was Chubb, Travelers, The Hartford, and Arch Capital. And so, yeah, our QBE thesis is partly predicated on the successful turnaround of their North American commercial business. Now, that North American commercial business consists of sort of 3 parts. One is the property business, where QBE is sort of slowly walking away from less profitable underwriting. 2, the specialty lines business, which actually has pretty good returns. And then 3, this middle market business. Middle market is small and medium enterprise customers that are traditionally managed through the broker channel. QBE has never really generated a great return in that business. And so I went to the US to sort of understand the logic behind wanting to turn around that business. Is this a good business at heart? And is it worth QBE's time to do this work? And really pleasingly, all of the customers I met with called out their middle market business as their crown jewel. Good returns, much more stable than the larger commercial businesses. And that for me was a great sign that QBE is on the right path here. I think the next question is, while these competitors have good middle market businesses, can QBE actually build a good middle market business? And to be honest, that's where the feedback was a little less clear. You need to have good relationships with the brokers. You need to have a good technology platform. And so, the takeaway is we need to go to management and really get in the weeds a bit more here and understand the extent to which they believe they have the systems and the experience in their business to execute this turnaround properly. I think, though, taking a step back more broadly, the feedback from all those competitors we met with was broadly that the sector is on fire at the moment. They're getting really strong rate growth, which is driving great operating leverage in their business. They're finally getting a yield on their investment portfolio after a pretty ordinary 5 years, all of which is driving pretty material earnings growth across the whole sector. And a rising tide lifts all boats in many respects, and QBE is benefiting from that.
Thanks. It's staying with you. So it wasn't always, New York and Vegas and the glamorous locations. We also shipped you out to some far less glamorous locations. Can you tell us what you learnt meeting with Santos's Alaskan assets?
Yeah, no problem. So I was very fortunate to head up to Anchorage and then onto the North Slope to see Santos's Alaskan asset, Picker. If you pulled up Picker on a map, it is unbelievably remote. It's right at the top of the North Slope. And to be honest, that remoteness, as someone who's not an Alaskan oil and gas expert, was cause for concern. I think the key takeaway, though, for me was it's amazing the level of infrastructure that's already in place in that part of the world for oil and gas projects, just given that they've been operating, oil and gas has been such a strong industry in Alaska for so long. I think the other major takeaway was the regulatory environment in Alaska with regards to these projects is much more progressive than some of the stuff we're seeing in Australia at the moment. And so overall, I definitely came away incrementally more positive on the project.
Great, thanks, Joe. And over to you, Jack. So you met with Albemarle, which is one of the world's largest lithium companies. Lithium is making headlines daily as prices keep falling. One of our core portfolio holdings, Mineral Resources, obviously have a large lithium business. I'm interested in your insights and I guess what you see as the outlook for lithium pricing from here.
Yeah, so Mineral Resources has iron ore operations, lithium operations, mining services, and now natural gas. And so just first thing to point out is that it's not entirely contingent upon lithium, or at least a bullish lithium outlook for success for us in that stock. As you mentioned, I did meet with Albemarle. I think, and as you alluded to, lithium prices have fallen due to concerns of a Chinese slowdown and destocking. What they did mention was the fact that demand is still remaining sound, and it's above what they had previously expected, with the exception that anything that's touching consumer electronics currently is a bit weaker. So think laptops and phone batteries, which are smaller consumers of lithium as a source of end demand. On the demand front, on the medium term for us, we see that remaining robust due to the energy transition. It's 4x in terms of demand growth since 2018, and we expect it to double by 2030. I guess a lot of the discussion has been on where the new supply is coming from and what the impact that will have in the near term. You can look at the mine plans and the production plans, and you can see that it is possible that does go into a surplus in the near term. What we would point out, though, is that looking at every mine around Australia, or almost every mine, these mines have taken just that little bit longer to get into production and that little bit longer to get to full operating capacity. So we would caution that while we are cognizant of that ongoing production, that forthcoming production, that it can take a bit longer for it to take place, and we think that is supportive of prices. But just to point out, our thesis on Mineral Resources is not contingent on a higher lithium price, as I mentioned before. We expect them to almost triple their lithium production over the medium term, and feel that that can more than offset the fall in lithium prices. In addition to that, they're also in the process of transitioning their iron ore operations from high cost and very marginal operations into a lower cost operation through its Onslow Iron Ore project, and they'll more than double their iron ore production at the same time. We actually had a colleague who was there just this week seeing those operations, and the guidance for first ore was reaffirmed, as well as expectations around future tonnes, and we remain very optimistic on that asset.
Great. Well, thank you guys both for joining me. It's been very insightful for me, and thank you to all our listeners for tuning in.